Right now, as we observe the market in real time, Bitfarms Ltd is trading on the Toronto Stock Exchange at approximately $3.98 CAD, showing a robust intraday upward move of roughly 3.6%, while its US-listed counterpart on the Nasdaq hovers in the $2.80 to $2.85 USD range, reflecting similar bullish momentum. If you are watching the charts on your Robinhood app or tracking the ticker on Fidelity, you are seeing a stock that is actively fighting to break out of its recent consolidation channel. The volume is ticking up and the tape is painting a picture of renewed interest, but the green percentage number you see on your screen hides a much more complex and aggressive battle happening behind the scenes. Most traders look at Bitfarms and simply see a Bitcoin proxy, a stock that goes up when the crypto coin goes up and crashes when the coin cools off. That is the expectation. It is the easy narrative that fits neatly into a SoFi Invest headline or a quick CNBC soundbite. But the reality is significantly more layered. Bitfarms is currently in the middle of a high-stakes metamorphosis, transitioning from a pure-play cryptocurrency miner into a diversified energy and infrastructure powerhouse, all while fending off aggressive external pressure from competitors like Riot Platforms. If you think this is just about mining digital coins, you are missing the forest for the trees. This is a story about energy rights, geopolitical arbitrage, and a fight for survival in a sector that is rapidly consolidating. When you open your Interactive Brokers trading terminal or check your Schwab Intelligent Portfolios, you might notice that the broader crypto mining sector is behaving differently than it did during the last cycle. In the past, these stocks moved in unison, a rising tide lifting all boats. Today, we are seeing divergence. The market is beginning to separate the efficient operators from the capital-intensive laggards. Bitfarms finds itself in a fascinating position here. The company recently released its November 2024 production and operations update, and the numbers tell a story of aggressive hardware turnover. They have achieved an operating hash rate of 12.8 exahashes per second, or EH per S, which is a staggering 100% increase year over year. To put that in perspective for someone who might just be getting started with online investing or looking for investment help, doubling your computing power in 12 months in a hardware-constrained environment is an operational feat that requires precise supply chain execution. They are not just plugging in more machines, they are swapping out older, less efficient units for the Bitmain S21 Pros. This is akin to an airline replacing its entire fleet of gas-guzzling older jets with fuel-efficient new models while the planes are still in the air. The result is an efficiency target of 19 watts per terahash, a metric that matters immensely when your primary operating cost is electricity. However, the price action we are seeing today isn't just a reaction to hash rate numbers, it is a reaction to the strategic tension in the boardroom. You may recall the hostile takeover attempt by Riot Platforms earlier this year. This was a massive narrative driver, creating a floor under the stock price as investors speculated on a buyout premium. That situation has evolved into a settlement, with Riot now holding a significant stake and board representation. For the retail investor holding shares in a Fidelity brokerage account or a Fidelity wealth management portfolio, this changes the thesis. It is no longer just a buyout play, it is now an influence from within play. Riot is effectively looking over management's shoulder, ensuring that capital allocation is tight and that the strategic pivot to high-performance computing isn't just a pipe dream. This adds a layer of accountability that was arguably missing before. When you compare Tesla stock or Apple stock to a miner like Bitfarms, you're usually comparing a product company to a commodity company. But with the introduction of the HPC strategy, using their massive power capacity to run AI workloads, Bitfarms is attempting to command a valuation multiple closer to a tech infrastructure firm than a commodity miner. The market is skeptical, which is why the stock is trading where it is, but if they pull it off, the re-rating could be substantial. Let's talk about that volatility for a moment. If you are using Robinhood Crypto or engaging in Robinhood stock trading, you know that volatility is the price of admission. Bitfarms has a beta that makes the S&P 500 look like a flat line. Today's 3.6% move might just be noise in the grand scheme of a week, but the technicals suggest a tightening coil. The stock has been compressing, and when miners compress while the underlying asset, Bitcoin, holds high levels, currently trading near the $97,000 mark, it often precedes a violent expansion. The disconnect between Bitcoin's all-time highs and Bitfarms' current share price is the curiosity loop I mentioned earlier. Why is the stock not at $10 if Bitcoin is near $100K? The answer lies in the halving. The event in April cut revenue in half for the same amount of work. Investors are waiting to see if Bitfarms' efficiency upgrades can offset that revenue slash. The operational update suggests yes, but the quarterly earnings, showing a net loss of $37 million in Q3, remind us that profitability is still a moving target. This creates a tension between the bullish macro backdrop and the bearish accounting reality. While we're on the subject of holdings, I want to hear from you. Comment below how many shares of Bitfarms you currently hold and what your average entry price is. Are you underwater from the highs of 2021? Or did you scoop it up in the lows of 2023? Also, do you think the pivot to AI computing is a distraction or the savior of the company? Let the community know your stance. Continuing with the analysis, we have to address the geographical diversification, which is a key differentiator for Bitfarms compared to peers you might find on investing sites or SoFi stocks lists. Unlike some competitors that are purely Texas-based, Bitfarms has a massive footprint in Canada, Paraguay, and Argentina. This sounds great for risk mitigation until you factor in the political instability and currency risks in South America. However, the energy arbitrage there is undeniable. They're securing power at rates that are unheard of in North America. The recent news about the expansion in Pennsylvania through the Stronghold Digital Mining acquisition is a clear signal that they are trying to rebalance their portfolio back toward the United States. This is likely a direct response to investor demand for lower jurisdictional risk. Institutional capital, the kind that's managed by Fidelity Investments or large Fidelity mutual funds, prefers the safety of U.S. law. By acquiring capacity in Pennsylvania, Bitfarms is making itself more investable to the big money that is currently sitting on the sidelines. The HPC narrative is where the expectation versus reality dynamic is most potent. The expectation is that every miner can just switch their machines to AI and make billions. The reality is that Bitcoin mining uses ASICs, or application-specific integrated circuits, which are useless for AI. AI requires GPUs. To pivot, Bitfarms has to physically swap out infrastructure, upgrade cooling systems, and secure different types of fiber optic connectivity. It's not a software switch, it's a construction project. Bitfarms has committed to a pilot site in Pennsylvania for this exact purpose. They're dipping their toes in the water rather than diving headfirst, which is a prudent approach given the capital costs. This measured pace might disappoint the moonboys on Twitter who want an overnight AI pump, but for a serious investor using a SoFi robo-advisor or managing an individual brokerage account, this fiscal discipline is reassuring. It suggests that management is not just chasing hype, but is trying to build a sustainable parallel revenue stream. Let's look deeper into the trading volumes. On platforms like Interactive Brokers, we are seeing a fascinating mix of retail and institutional flow. The average daily volume has been healthy, often exceeding 10 million shares, which provides the liquidity needed for larger players to enter and exit. This liquidity is crucial. One of the risks with smaller miners is that you can get trapped in a position during a liquidity crunch. Bitfarms, being one of the larger caps in the space, though still small compared to NVIDIA stock, offers enough exit liquidity that it remains a favorite vehicle for traders playing the crypto volatility. The institutional ownership has also seen a shuffle. With the Riot settlement, we essentially have a strategic partner who is also a competitor holding a large bag. This creates a frenemy dynamic. Riot wants Bitfarms to succeed because they own a chunk of it, but they also want to dominate the space. This tension effectively puts a floor on how badly management can perform. If they slip up, Riot is right there to demand changes or launch another takeover bid. It acts as a safety net for the share price. Now let's strip away the stock market noise and look at the company itself. Bitfarms is a vertically integrated self-miner. That means they don't just buy machines and host them somewhere, they often own the electrical infrastructure, the transformers, and the on-site maintenance teams. They were founded with a focus on using surplus hydroelectric power, particularly in Quebec. This green angle was a major selling point in the ESG, environmental, social, and governance investing era of 2020-2021. While the market cares a little less about the green narrative right now and more about raw profitability,